right? It has some monetary value. These are called economic resources. The other definition is more of the financial definition, which is if it has expected future benefit, if this resources has a future benefit, it means that is the asset. So we are not, sharing more light on this expected future flow, because this is finance subject. So we will explain in finance what is this. Liabilities. Okay, any question? I heard some voice. Any question? Okay, no more question, then let's move forward. Liabilities. Liabilities are outsiders' claim on the business. Outsider claims. Right? Owner's equity, insider's claim. If you don't understand that, let's explore the equation. Simple. Assets is equal to liabilities plus owner's equity. Right? So it means if a company owns assets of 1,000 and owners contributed only 400, it means 400 of the company resources are financed or are invested or are provided by owners. So it means outsiders, creditors, lenders, how much they provide? 600. Right? So what is the company's total worth? How much the company owns? 1,000, in which 400 value provided by owners, 600 value provided by outsider, either in the form of loans, short-term liabilities, long-term liability. We'll talk about that in our coming lecture. We will further explain what are the categories of assets, liabilities, owners, equity. There are different ones. So I'm just going slowly. Right? Okay. So other two definitions, they are more of finance. I'm just going to tell you here, but I'm not going, in details. So expected future sacrifice. So normally when we talk about sacrifice, it means cash outflow. Benefit mean cash inflow. Cash inflow. Come on. Cash inflow, it means cash coming into the business, which is a positive sign. Normally we denote it with positive. Cash outflow, which is cash going out from the business, we denote it with negative. Okay. So the owner's equity are the insiders' interest in the assets, or insiders or stockholders or owners' contribution towards the company's total assets. Right? Let's move forward. So the assets are, so before going into these details, so let's assume the Gap Incorporation. I think everybody knows about the Gap Incorporation. This is a famous clothing brand, right? Old Navy, Gap, right? So let's talk about it. Assets, cash and cash equivalents, like your cash, bank account, all the coins, all the cash in hand, dollars, different currencies, right? Inventories, all the clothes that you did not sell yet, it's still with you. That is inventory. Or in other books, we call this stocks, right? Normally, In accounting, we call it inventory, but if we go to the British accent, they call it stocks. But we are just uh, learning here with American perspective, only inventories. I think that is more. Just remember one thing, inventories, which are those which you, the cloths, the processed cloth, the finished cloths that you still with you that you didn't sell, right? We call this inventories. Plant, property, equipment. Property, the buildings if the company owns, not the rental building, right? The building, ownership. Plant, like machineries, like sewing machines and all those stuff, different kind of coloring plants. Equipments, ACs, water cooler, computers, right? These are called equipments. Liabilities, accounts payable. You purchase a raw cloth from your suppliers, but you said you will pay them later. So you create a liability. It means you have to pay to the outsider. So that's why these are liabilities. Outsiders claim, right? Taxes, any kind of taxes, sale tax, property tax, federal tax, provincial tax, whatsoever, belongs to you? No, belongs to outsider. That's why it is liability. Outsiders claim. Long-term debt, you ask loan for more than 1 year, 5 year, 2 year, 3 years loan. Outsiders claim. Current portion of long-term debt. So you asked loan for 5 years and you said every year we will be retiring $10,000. So every year this 10,000 among 50,000 is due every year, right? So you ask loan for 50,000, you said every year we will be paying you 10,000. So current portion of long-term debt. Long-term debt was 50,000 and this year we retire or we pay back 10,000. So left is 40,000. Right? So this is called the current portion of long-term debt. Owner's equity, right? We define assets, we define liabilities. What are the owner's equity? You can also always rearrange the formula, right? So basically owner's equity is comprised of two. Well, one is paid in capital, the amount that the stockholders or owner invested into the business, plus all the earnings that company did not distribute to the owners, rather it retained in the business. For example, company made 1 million profit and company said, if we pay you 1 million, you will get the 1 million, but next year we need $1 million because we are expanding our business. And if we pay you this profit, then we have to go to the bank and ask loan. And loan is not free. You have to pay interest, right? So rather giving you guys 1 million, we are not giving you right now. This 1 million belongs to you, but we are not paying you. We will be reinvesting this and we are buying plant next year, or we are saving for plant that going to be replaced in 2 years. We need $2 million. So 2 years earning, we are not distributing that. So that earning that you did not distribute, you rather keep in the business. We call this retained earnings. Look at the word retained and then earnings. Earnings that are not distributed to the owners, rather retained inside the business. But that earning belongs to owner. So that's why we call this a part of shareholder equity. So shareholder equity consists of two things. Number one, how much they invested in the business, plus how much belongs to them. The part of profit that company did not distribute, retain it with itself, that also belongs to the owners, not the outsiders. Okay, so some students are confused. Okay, maybe this profit also belongs to the liability holder as well, or outsider. No, this, the profit belongs to the owners. Owners are insiders. So that's why profit belongs to them. For liability holders, interest belongs to them, right? And while finding out the profit, we deduct the interest. That is our cost. So profit purely belongs to owners. So that's why all those retained profits that we didn't distribute, that belongs to equity or stockholders' equity or owners' equity, right? These are one and the same thing. If you just write down equity, it's okay. If you write an owners' equity, it is also okay. If you write down stockholders' equity, it's one and the same thing. Different names of the same thing. Okay, everyone? Understand? Good. We just talked about the categories or two things that constitute the stockholder equity. Number one is paid in capital, and number two is retained. So what is paid in capital? It's a common stock. Like you buy shares, you pay $30 for one share and you bought 1,000. So how much you invested in the business? 30,000. So 30,000 is your paid in capital. Company announces dividend for 10 on each stock. So you purchase $3,000 stock. So it means, sorry, you purchased here 1,000 stocks. So that is 30,000. So company announces $10 per share dividend or profit that company is going to distribute. It means you will receive 30,000. So 10,000. But company says, we don't distribute you right now, we will distribute you later. Because we will be setting aside some money. We are making fund to expand our business, to buy a plant, machinery, or some property, something else. So it means 30,000 here is your investment in the form of paid in capital, plus you also deserve to be given this profit as well, but company retained with itself, right? So that also belongs to you. So your total ownership will be, ownership would be now 40,000 rather than 30,000. Understand, everyone? Pinjo, Isaac, Ella,
Yeah, it's clear.
Yes, sir.
Nam, Harry,